So this is the consolidation, the first one. And at this level, you should be expecting a mixed group or console with various subsidiaries and probably an associate. Now, you need to be very, very careful when you are doing your console. In console, whenever you have a subsidiary, the type of accounting you use is called acquisition accounting. And whenever you have an associate, the type of accounting you use is called equity accounting. So there are different forms of accounting applicable to the subsidiary and the associate. Now, the type of accounting, like I said, that is applicable to a subsidiary is called the acquisition accounting. Acquisition accounting. All right. So we have acquisition accounting. The acquisition accounting is applicable when you have control. All right, when you have control. That is the most important thing. And it is done immediately you have control. Immediately. And the acquisition accounting says that immediately you have control, there are 4 things you must do. Number 1, all right, is to determine the ownership. The ownership. And in determining the ownership, that's where you do your percentage and all those things. And determine the date of the acquisition. Date of acquisition. In that, you have to show us who is the acquirer and who is the acquiree. Please, this thing is coming from acquisition accounting, IFRS 3. All right. IFRS 3, business combination. Then number 2, it says that do the fair value of the net assets. Fair value of the net asset. Now, we did business valuation. We learned that this net asset is the same thing as equity is equal to asset minus liability. The equity part is what we call net asset. So if I have my equity part, therefore, I will pick my equity part. Then any omissions that were done in this thing that should result in my equity, I will do that. I will pass it. We call those ones fair value adjustments. All right, that is it. So anytime you are doing your workings to use this accounting equation. Use this because the fair value adjustment is not only on assets, it is also on liabilities too. All right. Now, third step, the acquisition accounting says determine goodwill. So you will do goodwill. So goodwill is done only when there is control. It's done once and for all. Take note of that. Then the last one, it says do NCI. Of course, your group workings 5 is just supplementary. It is not required by IFRS 3. It's just supplementary. You only do this when you have control. So if you don't have control, you won't do acquisition accounting. And control means when you have more than what? 50%. Is that not it? When you have more than 50%. So take note of that. So this is what we are going to practice, and this is what consult is about. So each consult that you are doing, that is why you do a workings 1 compulsorily. It's not like
let me draw you back a bit. Let me draw you back.
All right, sir.
The 50%. Is it when you acquire more than 50% or 50% and above?
It's the same thing. 50% and above means more than 50%.
More than 50%, that means 50 is not inclusive.
50 is not inclusive. 50 is not inclusive.
50 and above, that means
when you have 50, somebody also has 50. You can't control the person.
Okay, very well.
You understand? So control. Okay. You have to have more than 50 to be able to control the person.
Okay, very good.
All right. So basically that this is business combination. It is marriage combination. Yes, it is marriage combination. All right. So now that is that. So in this our first question, we are going to learn to draw the group structure, which is this one. And we will show the acquiree and we will show the acquirer. We are going to do that. When we finish, we are going to do the fair value of net assets. If the subsidiaries are 2, we will do 2. If subsidiaries are 3, we will do 3. If they are 10, we will do 10 for each and every individual subsidiary. All right. Okay, so now let's draft it. Let's go to this one and draft it. So workings 1, let's fish out. If you're able to do your workings 1, it helps you a lot. This one say Better PLC operates in the manufacturing sector and has been hold on. So let's draw our group structure. So that will be our workings 1. It is not just a workings. Remember, we just learned that it is required by IFRS 3. That's why we do it. So who is the acquirer? We will read the question, find the acquirer, and find the acquiree. It says that Better PLC, which operates in the manufacturing sector, has been surviving the challenges operating in the Ghanaian economic environment. The draft financial statement of position is what you see here, as at 2016. So you have Better, Jewe, and Gaba. Now, you have their properties, PP, and investment in the subsidiaries. So you see investment in this subsidiary, all right, and you see investment in this one. I think this thing is supposed to be, yeah, is it correct? Yeah, it's correct. That's how it is. So that is the investment in the subsidiaries. Now, we read on, it tells us the equity side, the current asset, it tells us the equity side and everything. We have all those things down. Then we have the following information now are relevant to the preparation of the group financial statement. We are told that Better acquired 60% of the share capital of Jewe. So right there, you need to have Better acquiring 60% of Jewe. How many? 60%. So we have the acquirer and the acquiree. What is the date of the acquisition? They bought this on November 1, 2012. What is that date to the reporting date? We need to find out in our question. What is our reporting date? We are supposed to report this thing as at 31st October 2016. From this acquisition date to the reporting date, how many years is that? How many years is that? Count well.
4 years.
4 years.
Four
All right.
years.
4 years.
4 years.
So you write there 4 years. Please do write it. Not only that, they said that and 10% of GABA. So it means we need to draw GABA somewhere. But hold on, because you may be tempted to draw it like this and put GABA here. But hold on, finish reading your question first. 10% on this one, and you have been given the cost of purchase for the two, this one and this one. Perhaps that is what combines for you to have this. So that is it. And again, they said Jewe PLC acquired 70% of the share capital of GABA. So right there, you can now draw this one. This one too acquired like this. He acquired 70%. And which date did he acquire? November 1, 2013. And if this thing is 4 years, then this one will be 3 years. So we go back and we are told that this Better also acquired 10% of GABA. On which date? November 1, 2013. This is also 3 years. So, Julia, you asked me this question the day I was teaching this thing. This is your D shape. This thing is called mixed group. This is the D shape. Why we call it D shape is because it looks like D. Have you seen it?
Yeah.
All right. So this is it. In this case, when you are done with your structure, you find your effective control and effective NCI. So effective control, how much control? Of course, as for beta and Dewey, we know it's 60%. But what about beta and GABA? What is the effective control? The effective CI, therefore, will be what? 60%
By 70.
by 70%. Then he also bought directly 10%.
So plus 10%.
Plus 10%. So what this means is that you, Jewe, I own you 60%. You too, you're going to own somebody 70%. So better share inside this GABA is 60% of the 70% that Jewe has inside it. And that is, what percentage is that? This gives 52%, right?
42. Okay.
So your effective NCI for that one will be what? 48%. All right. So you've done, this is your workings 1, done. Then you are going to do your workings 2, which is the net assets. So you do fair value of net assets of Jewe at acquisition, at reporting, post acquisition. This
Mama,
is where,
please, let's
yes,
talk
please.
about the dates of acquisition, the effective date of acquisition.
Is this date, the date they had the control is the November 1, 2013.
Okay.
That is where control into this ones happened.
Okay.
Yeah. So then you come again, you do fair value of the net assets of GABA. The same thing at acquisition, at reporting, then you will have post acquisition. This is where tuitions differ. This approach, some people don't draft it like this. Everybody has his own style. For me, this is it. When you finish, remember, everything is in millions, okay? Everything is in millions. Now, when you draw this, don't forget the equation you are using to do this is E is equal to A minus what? L. So you will start looking at the E side of them. So when you look at the E side, you start seeing stated capital, of course, basic consolidation. Stated capital, you have, this guy is 600, 600. Is that not it? This guy's stated capital is what? 300, 300. There is no move. Stated capital doesn't change. All right. Then what next? Retained earnings. Now, what is the retained earnings? If we are going to use the retained earnings, first write the reporting ones first. 540. Always write the reporting ones first. 390. Then go and read your question to find out the one at acquisition. If you go on, now let's take the opportunity to finish reading everything in the question. He said that when they bought it, this was the purchase considerations for both the 60% and the 10%. All right. And they said that Jewe acquired 70% of the share capital of GABA on this date. Then the balances of their retained earnings were, so as at the date, each one acquires each date. So each one acquired. So the retained earnings of Jewe at this date is this, and these are the respective dates. So if we want to, example, know the retained earnings at acquisition, when was the Jewe bought? We are told that it was bought on 1st November 2012. So 1st November 2012, we will pick the value retained earnings at Jewe. This is the time they bought it, 270. So here will be 270. The movement 270 to 540, that's like times 2, so it's 270 also. That is the movement. If you want the retained earnings of this guy, when was it bought? It was bought on this date. Look at the date it was bought. The date this one had control into this one was this date, 2013. So if you now want to know the retained earnings at GABA, as at the time it was bought, this is GABA PLC. If you want to know their retained earnings, you don't pick this because this is not the date it was bought. You come and pick the date it was bought, which is 240. All right, that is that. 240. So that is what you go through to do. All right. Now, the next thing for you to discover is that we need to check this next item, which is the OC, but you see, it's dash dash. Nothing is there. Nobody has anything inside there, so nothing is there. So since nothing is there, we move on. All right. Now, we won't do any OCE here. Nothing will be there. But we read through the question. It tells you that at the respective dates of the acquisition, and other things about acquisition, the fair value of the net asset of Jewel PLC was 930, and for GABA 660. So you see, this fair value of net asset of Jewel, fair value of net asset of Jewel at acquisition is 930. So he has given it to you already. So it says that the difference in the fair value and the book value of the net asset relates to a non-depreciable land. The fair value of the non-depreciable of the non-controlling interest in Jewe at the date of acquisition was estimated to be 390, and for GABA 330. This is the values of the NCI, fair value, NCI at acquisition. And it says that better adapts the full goodwill method. So full goodwill method means that they adapt the fair value method. All right, so that is that. So, and they adopt the full goodwill method under IFRS 3 business combination to account for the non-controlling interest. All right. Note 4. Given the economic environment of GABA, the impairment test carried out for the subsidiary was it was discovered that whereas GABA suffered no impairment loss due to its line of business, Jewe had impairment loss, so we will do impairment loss. During the year ended, Beta sold goods both to Jewe and GABA. The invoice prices for the inventories were 480 and 360, respectively. Beta invoices goods to achieve a markup of 25% on cost to all third parties, including the group companies. At the year end, half of the inventory sold to Jewe remained unsold, but the entire inventory of GABA is what still had been. It said that, but the entire inventory sold to GABA PLC had been sold to third parties. All right, so that is that. Okay, so that one has been sold. So we don't have a problem. There is no inventory still in stock. So that is that. So as far as this one is concerned, there won't be any provision for unrealized profit. It has been sold. There is no inventory still in stock because PAP is calculated on inventory that are still in stock. All right. So that is that. And he said that, so this one is PAP and the parent is the one that sold. So the workings will be in workings 5. It will be reflecting in your workings 5 group retained earnings. Better purchase a deep discount. These are the things. Then it brings you on board to IFRS 9 again. They purchase a deep discount bond, an innovative financial instrument in the capital market for 500,000 on November 1, 2015, switching from the equity holdings in the market where the equities have suffered huge losses. The bond will be redeemed in 3 years' time for 740.75 million and are carried at amortized cost in line with IAS 39. This is supposed to be IFRS 9. All right. now. It used to be IAS 39, now it's IFRS 9. The accountant is not clear as to the correct treatment of the amortized cost, and as such has not passed the correct entry to give the effect of the amortized cost valuation. As such, the financial asset is shown as 500. So we have two discount rates. The question is, which discount rate are you going to be using? Then you have been asked to prepare this thing. All right. So now, how do we go on to do this? We go back and start doing all the things that we have to do. All right. So we were given this value, the total here, and the total here. We were given, and in level 3, it is normally given. It is normally given in level 3 console. It is always given. If you check your past question, you realize that most of the time it is always given. And so this one was given to be how much? The fair value of net asset at acquisition. This one, fair value of net asset at acquisition. This one is 930, right? And this one is 660. So when you total this and this, you see it's not balancing. The question told you that the difference is a fair value adjustment on what? And on depreciable land. It told you that. So what is the difference? So this one too, the fair value land. What is the difference, please? 60. So 60, 60. All right. Please, like I always tell all my students, the middle one is of no use to you. So don't bother yourself trying to calculate anything on that. Don't bother yourself. So this one too, what was the difference here? 240 to 390 is like 150. So that one too, you have a fair value adjustment. What is the difference? Yes, what is the difference, please?
120.
So 120. 120. So you are done. You know that you will be sharing these things. So that is your workings 2. All right. Then you have workings 3, goodwill determination. This is where it gets interesting because there are 2 subsidiaries. So goodwill we will do for Jewe and we will do for Gaba. And immediately you finish the goodwill, go and start preparing your balance sheet. So we need yes, please.
Please, I saw that you did not do anything on the cost of investments. Sometimes some of the solution you see that they've done the cost of investment.
They've done cost of investment. Cost of investment is just purchase consideration.
Yes.
And we are now coming to do goodwill to start with purchase consideration. Where do they do it? In the workings 2?
Yes, they do it separate.
That is why I tell you that approaches differ. You see the things that we were telling you.
Yes.
Approaches differ.
Okay.
People can do it like that. Approaches differ. That is the danger.
Okay.
Yeah. Because people don't even do this post-acquisition here.
Yeah. And
exactly.
I've even seen some solutions that they've even added OCI after the post-acquisition.
Well, I don't know what the one that you are talking about, but OCI is not a P&L item. So
yes.
I don't know. It's not a retained earnings item. So that is it.
I think it's referring to OCE.
Maybe OCE, not OCI.
Yes, OC, sorry.
And that one there you can do if it is in the question. But this one we don't have such. It is here, OCE, but we don't have it here. This is dash dash. So that is why. So the purchase consideration now comes in here. How much did they bought Jewe? We were told that Jewe was bought at a price. Said the cost were 852 and 258 respectively. So the purchase consideration for this one is 852. And here you need to be careful, because here you have a direct. He bought 10% direct. 10%. If you check your group structure, you will see that the parent bought 10% direct himself. So the 10% direct, he bought it at 258. Then the indirect, do you remember how we do the indirect? The controlling percentage of what S used to buy SS. So this guy owns 60% of what S used to buy SS. How much did they pay for the 70,000? We don't have it here, so it means you have to go and check the balance sheet. The investment in the subsidiary, he purchased, this is it, 600. So the indirect one is like this. So it means that when you do the multiplication, what are you having? Where's my calculator? We have 0.6 multiplied by 600. That gives me 360. So that is it. Then after determining this this purchase consideration, what do you do when you are doing goodwill? NCI at acquisition, is that not it? So what is the NCI at acquisition? They said they used the fair value method, and they gave it to us somewhere down here. They said the fair value of the non-controlling interest in Jeway at the date of acquisition was 390. And for that of the other person, Gaba, is 330. Then what do you do again? Less fair value of net assets of SAP at acquisition. So this is what some people structure it differently. So they will go straight away and bring the purchase consideration and do this part only under it to find a goodwill. But it's the same thing, it's just a differences in approach. So here, what we are lessening is 930. And here what we are lessening is what? 660. All right. This is it. This is it. So that is it. That is how you determine goodwill. And how much is the goodwill for this guy? So 852 plus 390 minus 930. That gives 312.
312.
And the impairment for this guy, we were told that it is 60, right? In this note, 60. What is the figure here? 258 plus 360 plus 330 minus 660. That is 288. And there is no impairment. So if we do our deduction, minus 60 is 252, right? And here is 288.
If in case the impairment were not given, how do you determine?
So if it is not given, why will you be looking for it? If the question says no impairment, there is no impairment. You can't force yourself to bring in impairment when the question says there is no impairment. Sometimes what he can do is that he can give you the recoverable amount. Then you bring in IAS 38 because this is goodwill at acquisition. And that one, you compare the recoverable amount with the goodwill at acquisition. The difference is the impairment.
Okay.
But that means the question has given you impairment. So if he doesn't give it to you, then he didn't give it to you. You can't force it. So the total is what? 540, right? So this is our goodwill. So right there, let's go and draft our balance sheet and slot it there before stop work. You have not done a balance sheet. So we have beta group. Then you have statement of financial position. As at 31st, what is the date? 31st October. October is 10, 2016. For me, I have developed the habit of using the question and balancing everything on the surface of the question. Yeah. So I have here, our answers are in what? In millions. So in million. So I have my Goodwill. So I just slot it. Workings 3. We had 540. So that by the time stop work has come, I have done something. And when you finish that, just copy and paste what you have here. All right. So we have PPE. The PPE is 4320 plus 360 plus 420. And when we did our workings too, there was some land, non-depreciable land, which is 60 and 120. So you add them. Plus 60 from workings 2 plus 120 also from workings 2. All right, so you can total that. The next one we have is investment in subsidiary. If it was investment only, you would have written it and deducted, but this one is investment in subsidiary, so you can ignore it. Then you come to your financial assets. And there was a note on financial assets, so it means you have to also wait on that to see what you will do on that note. Then you have your current assets. All right, and there was PAP 2, so you have to also wait on it small. So here you have 1050 plus 570 plus 540. Then from there you move on to your equity. Draft it down. Draft it down. You have your stated capital for sure. As you can see, stated capital, that one is the same for the parent. So you can write that stated capital for parent is 2,400. Then the next thing that is there is the retained earnings. So that one will come via your workings 5. So you do group RE, group retained earnings, workings 5 down. So when you do your workings 5, you bring it. Then the next one is your OCE, right? And the OCE here is 450. All right. So that is that. You get your distance. Then you get your total equity. Then you come and bring in your NCI. All right, which will come via your workings 4. So that one you can drop it. Then after that, you get your NCL, but this question doesn't have NCL. After that is your CL. All right, so basically that is that. And your CL, you can do 720 plus 390 plus 270 down, waiting for any form of adjustment. So now let's go and continue. Whenever we finish each workings, we just come and drop it. Whenever we finish, we just come and drop it. That is it. So now we are at workings 4. So workings 4.
So we are done with our Goodwill.
Yeah, we've posted it already.
Okay.
So workings 4 is NCI. How do you do NCI? NCI, we have Jewe and we have Gaba. Don't forget, our NCI percentage for Jewe is 40% because we had 60. Then this one, effective NCI was what?
52 or so.
48.
48 of
48. All right.
48.
So 48. So that you don't forget. All right. So we start with NCI at acquisition. Fair value of NCI at acquisition. And it is in our workings 3 already. So it's 390 and what? 330. So you pick that one, you drop it 390 and here is 330. So you have that. Then the next thing you do is what? NCI share, because this one is a full goodwill method, right? So NCI share of post-acquisition, how much do you have? So this side will be 40%. What was our post-acquisition for Jeway? 270, and this one was 150. So 40% of 270, please compute it. Then this side will be 48%. It's what? 108.
108.
Okay, 108. Then this one will be 40% of the 150. And how much are we getting for that?
72.
72. All right. Now, when you finish, there was impairment, right? So you share impairment for this guy. NCI share of impairment. Of the impairment. And that one will be 40%. The impairment was 60, so it will be 40% of the 60. This one didn't have anything like that. What will you get? Then what is the last thing we do in NCI?
24.
24 is impairment. What is the last thing we do in the NCI? The NCI of what S used to buy SS. If you know the template, that's it. So NCI of what S used to buy SS. NCI here is 40. How much did S use to buy SS? So you go and check here. You see, when you were here, you did CI of what S used to buy SS in the Goodwill. So you come here and do the remaining 40%. You less that one. So how much would that be? Of 600. How much would that one to be?
240.
240. So this is how you do your NCI for whether it is a vertical or a mixed. This is how you do it. If it is a vertical, the only difference is that there will be no direct purchase. That's all. That's the only difference. There will be no direct purchase, but the indirect will be there. There will be no direct. That's the only difference. All right. That's the only difference. So the template is the same. So here we can total everything. So what do we have here and what do we have here? So that is our NCI. There is no post-acquisition revaluation for them to share. There's no preference share, which is designated non-controlling. So we are done. What do we have? So that we can total our NCI. So straight
234 for
234 for Jerry, and this one plus this one is 402. Total is what? NCI carry down total
636.
636. So straightforward, you go and drop the 636 inside your balance sheet. You don't wait. NCI 636 is 636, not 363. All right, 636. You drop it. So
Please let me your balance sheet well.
you say?
Yeah. Please do it small.
Are you okay?
Hmm.
Are you okay? Can I move on? Are you okay?
Yes, please. Thank you.
All right. So this thing was 636. So we do our last workings 5. So workings 5 is group retained earnings. So what are the things that come here? The parent retained earnings. And the parent retained earnings is 3410. then CI share of post-acquisition in those two. So CI share of post-acquisition, we will do for Jerry, which is 60% of, was it 270, right? Then the other one is CI share of the post-acquisition of GABA. That is, what is the CI percentage in GABA?
16. GABA is 78.
78.
Yes.
How did you get 78? Is 52 or 78? If here is 48, that place will be 52. The controlling CI, effective CI, we calculated, is 52. This is it.
52.
So it is 52 multiplied by, the other one is 150. Or it is this one you've done to give us the 78.
Yeah, the post-acquisition profit is 150, right?
Yes. So because I typed it's 78. So I don't know whether your 78 was when you
Yeah,
have
78.
and the 0.6 by 270 is 162.
162, yes.
All right. So that is that. Then the PAPs, provision for unrealized profit. The provision for unrealized profit. It was only one person who had it because the other guy had sold everything. So the percentage was what? Provision for unrealized profit. They sold inventory, and this is it. Better sold goods, markup. He sold the invoice prices. These invoice prices will be selling price. So do we convert to margin or we leave it like that? This is a test.
We convert.
You convert because if I sold, I should be using margin, not markup. So if I sold, so it will be 25 over what? 125. Multiply by the inventory that is still in stock. The question said at the end of the year, half of the inventory in Jewe remain unsold. So if the inventory was 480 for Jewe and half was still not sold, we will divide this thing by 2. That is how we can find our PAP. Then the CI share of the impairment. The other one there, they said that he has sold everything out. So we won't do any PAP. It's 0 because we do PAP on inventory that are still in stock. So the CI share of the impairment will be 60%. Impairment was 60, right? So give me the figures for these two. Then there is another issue. So I tell you that anytime there is something concerning the subsidiary, it is dealt with in workings 2. So assuming the PAP, the subsidiaries were the ones who sold, it will be in workings 2. Anytime the additional information is initiated by the subsidiary, do those things in workings 2. Anytime the additional information is initiated by the parent, do those ones in workings 5. That is it. All right. So what will we get for this?
PAP is 48.
PAP is 48. Then the impairment will be how much? So 6 times 6 here, 36. Don't note it.
36.
Yeah. So we are left with this one concerning the parent. So let's deal with this one. So because the effect should be in group workings 5. So let's deal with that. So we are told that they issue a deep discount bond and it is 500 and it is on November 2015. So that is the beginning of our reporting year, just 1 year. It's just 1 year. So like the question said that we are supposed to use amortized cost. If you remember your IFRS 9, amortized cost is balance brought down, which here we know is 500. Then you bring in your finance gain. They purchased. So this one is a financial asset. And the question said that is the reason why the financial asset is showing 500 million. So the correct thing hasn't been done yet. So finance gain, then we have payments. We are not giving the, we are not told the, sorry, this is a financial asset, so it will not be payment, to be a receipt. We are not told how much they receive on daily, on yearly basis. So there wouldn't be any receipts. Then we have our balance carried down, which is supposed to show inside the balance sheet. So now, what is the finance gain? The 12% and the 14%, which one do you use? Given that this thing is 1 year, how do you determine the rate? You determine the rate by finding the proximity to the rate by doing 740 over 740.75 over 500,000. How much will you get? It's just 1 year, so we should be getting one of something in this environment. How much will you get? By 100%.
1.48.
48.
Multiply by 100%. You said 1.48 by 100%.
148.15.
Yeah, so that is giving you close to, in terms of percentages. Saying, what's it? Saying
148.15.
148.15.
So like that's like 14.18 something and that is 1.48. Is that not it?
1.48.
Yeah. So this is it. So your effective is 14%. So do 14% on this. We don't have the payment for here. So when you do the 14%, then you give us the, what do we call it? The balance. So the balance should be what should be reflecting inside the financial statement. Your 1.48 is kind of around here.
70.
As in 70.
The financial gain is, yeah.
70. So it means here will be 570. So inside the financial asset, in our balance sheet, it should be 570. And the gain is the 70. So the gain will come to your, normally this is a representation of your P&L. So finance gain of 70. Then the 70 will be added to the 500 that is inside your balance sheet to get 570. So this is it. 500 plus finance gain of 70. There wasn't any receipt, so here will be 570. Yes, somebody is asking a question.
I got distracted. I'll be happy if you could help me with the 70 again.
The 70, oh, it's just from the amortized table, 14%. This is it. We just did the amortized table.
I got distracted. Thank you.
All right. So that is how it is. All right. So now we found almost everything. So total this side, let's go. Total this side, let's go. Let's balance it off and let's go. There was PAP, so we need to deal with the PAP. The PAP was how much? We need to less the PAP from the closing stock. What was the PAP? 48, So less the PAP 2 from the current asset. Let's close out. Let's get our balancing figure. So this is working 5. This is like, let's say we're working 6. So get it, let's balance it off. See, if it is vertical, the only thing that changes is the direct. It won't come because there wouldn't be any direct purchase into the second the sub-subsidiary. All right. So please, when you total, what do you get? Somebody should total down. Somebody should also total the up. Let's find out.
Current asset is 2112.
Current asset is 2112. 2. Oh, just
PP 5280.
112. PP is what?
5280.
5280. So what is the total balancing figure?
Shoot.
11352.
The total balancing figure is what? It's what, please? Oh, it's 5,000. 8,000.
502.
8,502. Okay. Let's see if it will balance down here. So what are we left with? Our group retained earnings. And so you can close this one. Nothing affected it. 720 plus 390 plus 270. 1380. Did you get that? 1380. So let's go and do. Did you get that? The same 1380. So that we can go and the only thing left with our working is 5. Please confirm the 1380.
Yes, sir, confirmed.
All right, then let's go and total our this side and bring it in. So this one is a 3410 plus 162 plus 78 plus 8 minus 48 minus 36 plus 70. I'm having here 3636.
Yeah, 3636.
3636. All right. 3636. So let's go and slot it and check the balancing. So here is a 3636. There is a 6 here which will bring these two. 6. So it's
Yes,
likely to
balance.
balance. 2,400.
Balance.
It has balance. So
Yes,
give
sir.
us the total here. First 3636.
850.
Here is what?
Sorry.
I'm having 64686.
Sir, please, can you minimize the screen a little?
I should maximize it.
Yeah, I can't see the one at the corner.
Is it better now?
Yeah, thank you.
Okay. So let's do it like this. All right. So when we total this thing, including our 636, that is 7122. Then when we add it to our 1380, yeah, it balances. So 8502. All right. So basically that is how it goes. All right. That is how it goes. So the only thing is that if you don't know your IFRS 9, that part would confuse you. Yeah. Your question 2 is also, let me see, investment in this one, then investment in this one. It's also likely to be a D shape because this one, it says that the Mai PLC, he bought 70% in Biden at acquisition days, blah blah blah. Then Biden also acquired 80% in Yedun. And both Biden, okay, so that one is vertical. No, that one is vertical, so you can do that one too. You can test on the other one, your question 2, even before tomorrow. You can try it. It's vertical.
Okay. So are we meeting tomorrow?
And that one there, we will meet. We will meet tomorrow. We will meet tomorrow. So
In the morning.
yes, ma.